One of the things I saw earlier today was that Apple and Nvidia account for 20% of the average retail investor's portfolio. And Nomi, in your book, you talk about permanent distortion. That's certainly one if I've ever seen one. I guess my question to you would be, do you believe that investors will flock into equities, and do you think the S&P will go into further new higher territory, or what are your thoughts on the US stock market at the moment?
Well, it's interesting because if we are going to be in either rate cutting or dollar devaluing for all the reasons that we discussed environment, then the Fed, if it buys treasuries to basically, create more QE, more liquidity for the financial system, for the stock markets, that tends to be inflationary for equities, because particularly the larger players, it's not even retail, the larger players are the ones that are moving the markets. Retailers going into, BlackRock ETFs, etc. Those guys are basically pushing the power around. The retail investor gets sort of swept up in some of the individual buying, but also a lot of these like mega purchases by the rebalancing that needs to be done with the asset managers, ETFs, and so forth. And Nvidia has been obviously a large recipient of that. And as I say, and I may be speaking for Matthew here, but you can't actually buy things if you're a country with Nvidia shares. Like, you actually have to invest or have on the side something that is real. And one of the reasons that the BIS, as Matthew mentioned, has basically reclassified gold as a tier one asset. Back in the day, it was used in general as a currency before we had things called tier one assets, but is basically because of an offset to what's going on with the financialization of the market. In permanent distortion, I wrote about that specific thing, that basically the more and more that central banks, and particularly the Fed, have the ability and the unchecked ability to really create liquidity or reduce rates or increase QE or whatever backhand ways that those occur by, the more that liquidity is going to look for places to go. And that's why, even though the Fed was raising rates from March 2022 through the middle of the following July 2023, the stock market, with volatility along the way, with 1,000-point drops and all sorts of things along the way, effectively continued to rise. Because at the end of the day, even though those screws are being tightening on the cost of debt, which really hits consumers and hits the country, basically the United States pays $1 trillion in interest just on the treasury debt because of policy, where rates are and how much we have, before it pays for anything else, before it pays for its electricity bills. There's enough large players that can effectively amass still comparatively lower cost funds into assets and into equities.
Quick break here. This episode is brought to you by West Red Lake Gold Mines. Now, if you know nothing about West Red Lake Gold Mines, let me tell you one thing. This company was founded on the back of a transaction where they purchased the Madsen mine in northwestern Ontario in an area called the Red Lake Gold District, which to date has produced around 30 million ounces of gold from some of the richest gold deposits in the world. Now, what they paid for this mine versus what they got has led legendary mining entrepreneur Frank Giustra to call this transaction the deal of the decade. And Bob Moriarty, founder of 321 Gold, was recently on my show calling West Red Lake Gold Mines one of the two most undervalued gold companies in Canada. If you're curious why these individuals are so excited about West Red Lake Gold Mines, hit the link below to learn more. Now back to the episode.
I think we're going to see a shift because we are in a reductive environment, and because there will be other ways that the Fed and other central banks will find to monetize their debt. As Matthew said, we're basically in a debt-prone world, which is going to require those investors to really diversify substantially outside of equities, outside of Nvidia, outside of Apple, and into real assets. And I think one of the reasons, besides everything else we're talking about, that gold has appreciated by so much during this period, and will continue to substantially, I believe, and silver and copper and uranium and basically real assets that are involved in real necessities, whether that's currency, balancing wealth, or power or energy, that's going to continue. And I think that's where investors are going to go. And I think that diversification play into real assets is really just starting because of all of these other factors that we're talking about. And where the U.S. market goes, in general, I think it's going to continue to trend up because I do see a lot of these mechanisms being used by central banks in the event of an emergency to balance the budget of different countries, as the US or other countries and so forth. And ultimately, that is net positive for equities. Not that we're going to see the same increase in Nvidia that we just saw the last couple of years, but ultimately, with a lot of volatility along the way, it's positive. But that diversification is going to accelerate to real assets.
Yeah, I completely agree with a lot of the points Nomi's making. And in a perverse way, it goes back to your original question, Ted. You were asking about the economy, and we're kind of pretty bearish, pretty basically and empirically, objectively bearish. But to Nomi's point, the dislocation between that and the S&P or the stock of the Dow, the NASDAQ, is fascinating. This complete dislocation from economic fundamentals to an equities market or risk asset market on a more than just a respirator, but a massive tailwind. And this, coming from my hedge fund days where I was a lottery ticket winner, not a genius, there were smarter men in the room than me and women in the room than me, that's for sure. But I have kind of looked over the past when I think of the dot-com era, which is an easy comparison, but not a complete comparison. When you see a narrow market, there's all kinds of red flags. I saw that with Lucid and Microsoft and Amazon, and I'm seeing that now with Nvidia and the Fabulous 3, which is once the Magnificent 7 and the Fabulous 5. It keeps getting tighter and tighter.
Yeah.
And when those net income margins go from north to south, the selling starts. And when you have a market this narrowly held, that can be a very dangerous assumption. But to Nomi's point, in a perverse way, markets can go up because I think, and this is a real simplification, because I think price discovery died a long time ago when the Fed became the airbag under everything bubbles in all the risk asset markets, in particular the S&P, the NASDAQ. But it's very Pavlovian. When the Fed is hawkish, the markets tend to react negatively. When the Fed is dovish, the markets tend to react very positively. 2022, when the rate cuts came in, there was the worst combined nominal returns for stocks and bonds since 1871. That's more than just volatility. That's awful. But 2023, 2024, we saw markets going up and to the right. Why? Just the talk of rate cuts and the pricing in of rate cuts as far back as 2023 and early this year in 2024, when Powell put that carrot in front that we're going to have rate cuts. Everyone was guesstimating whether it'd be 6 or 7, et cetera. Just the talk of a more dovish Fed sent these markets galvanic, like children in a candy shop. Well, there's going to be lower rates. We can borrow, we can roll over, we can extend or pretend. That's bullish. And there is the possibility, with the caveat, be very careful when you have this much of a narrow market, which, as Jeremy Grantham at GMO, is far smarter than I am in equities. This is grotesquely overvalued market, grotesquely, dangerously overvalued market. So tread lightly those who walk into those steps. Know your exits and entries, and hope there's liquidity when you need it most. I saw that go very wrong in the dot-com bubble and even in the great financial crisis. So not trying to be negative all the time, but be very careful when you tread through that minefield. But in a perverse way, the government is so broke, there's almost, many have said, a vested interest in seeing the S&P nationalized like one big collective U.S. 401k. We need the tax receipts. We need the capital gains. The only good narrative America really has right now is it's ubiquitously rising risk asset or equity markets. It's sad that we hang on the edge of our feet on rate cuts and what Nvidia is doing. When you look at those empty stores, when you look at the 3rd Street Promenade as a metaphor, or Pioneer Square in Seattle, or Michigan Avenue in Chicago, that's appalling. And right. Keep in mind also, the vast majority of the wealth in the S&P goes to a very small minority of American citizens. That's not good for America. That's not even real capitalism. To me, that's Wall Street socialism. That is a subsidized S&P and NASDAQ and Dow, not a supply and demand driven Dow. But, David Stockman, Nomi, we all agree, natural price discovery and supply and demand died when the Fed took over supply and demand forces in our risk asset markets, and the supply and price of money is controlled by a central bank rather than balance sheets, income statements, and margins. So that's the feudalism we live in today.